Well, there's no stopping the bank Nifty. Even the Nifty is now joining in. 11,345 is what you have on the index. The Sensex is up about 0.6%. The Midcap, again sulking. The index is down about 0.5%. Now, don't lose sight of that because yesterday was the first sign of minor underperformance. Today, it's clearly that the money is essentially moving into the large cap. So, Midcap's underperforming. Sudarshan and Mitesh with us for BTST calls. Sudarshan, you go first. What's the approach now here? It's just a one-way, it's almost like a bullet train which is just moving on and on. Should you wait for the next train or try to board this one? And of course, what are your stock calls now?
Yeah, you're quite right. It's like a bullet train. And, sometimes standing in front of the train is dangerous. So we don't do that, but I won't get on it. We'll just wait patiently. The next one will come. So my index calls remain. Don't do anything. You have taken your profits and keep quiet. Stocks will keep on offering opportunities. I have Pidilite as a buy. Pidilite, after that small correction, for the last 3 days has been giving back-to-back gains. It's at this point, it's at the high of the day. This sometimes leads to upside momentum tomorrow morning. So as a BTST, it qualifies properly. So consider buying Pidilite with a stop at 1150 and a target of 1205. Asian Paints is my second buying idea. There's no question of short selling, anything. Asian Paints has been in a correction since the morning and the last half an hour has seen a handsome rally. That rally could take it to its earlier highs. I'm assuming that. So Asian Paints is a buy with a stop at 1418 and a target of 1448.
Okay, and what about you, Mitesh? What would the buy today, sell tomorrow calls be?
Yeah, I have Pidilite on my list as well. Stop at 1158, target of 1190, and Bajaj Finance is the other BTST call. Keep a stop at 2788 for targets of 2835.
Okay, so Pidilite seems to be the consensus for now. Prakash, what do you make of this renewed buying interest in DLF? Of course, today there's CLSA report as well. Yeah. But, even the last round, it didn't make a fresh low. And it's a stock which is beginning to outperform once again.
So, it seems much more convincing than before because we've seen it so range bound otherwise and it's finally kind of taken a significant move. And anecdotally, if you notice, all leading national level newspapers, they've started taking front page ads for the projects. They normally do that when their inventory is sellable enough and monetizable enough. The other thing that's happening is real estate is undergoing a little bit of a shortage on ready to dwell inventory, and this time around the focus segment, the target segment for most of these large developers, whether it's Oberoi, Godrej, DLF, is actually the end user. So the price points have come down. The RERA regime has really taken things in a very positive way from the consumer's perspective. So it's genuine buyers and dwellers who are buying into these projects. So and what Embassy, the REIT, is likely to do is put all of them into a very different orbit, especially the ones that have a lot of commercial inventory which could REITable. But I would look at, the moment real estate takes off, there's one segment that always benefits, and there's a company that rides that right at the top, and that's Cummins. You have a real estate project, you can't do without generators on site, you can't do without power backups. This is one company that's always had a correlation, very strong correlation with genuine construction activity going up, and it also does well. Till now, Cummins has benefited more from the export segment because the parent has been very benign, very supportive. But the recent move from the lows of 600 all the way to 800, you've seen a retracement. I think this is something that I would ride, not maybe real estate directly, because for the love for mid-caps continues to be very strong.
Okay, all right. That last point is imperative. But let's do one thing. Let's take a bit of a breather from this discussion. We still have about 20 minutes left for the day to end. On to some market opinion now. Morgan Stanley's Rhythm Desai is quite optimistic on earnings growth over the next few years. We did speak to him a while back earlier in the day, and he said that the markets have been very resilient to all the macro problems, and the up move can continue if there is a conviction of a majority government and if that gets priced in. Listen in.
We are at the beginning of a new fundamental cycle. Now these are long duration cycles. They tend to last for 5-7 years. So arguably I would say that we are at the beginning or maybe a few months into a 5-7 year cycle in which I think we should witness pretty strong earnings growth. Mind you, corporate revenue growth has already put a trough almost 2 years ago and has been accelerating. It will not surprise me if earnings, put in a 20% CAGR over the next 5 years. And then you step back and evaluate what the market is priced in. The market is not oblivious to a new earnings cycle, but certainly it cannot price in a long duration earnings cycle. What it can do is, look forward, say 6-9 months and put that into the price. The fundamental cycle is at the start of a new uptrend which could last for a few years. Valuations are somewhere in the middle of the zone, so there is upside there. And of course, there are near-term issues around elections. I would say 2003, both fundamentals and valuations were at bottom of the cycle. In 2019, fundamentals look like they're at the bottom, but valuations are not.
We speak to a cross-section of industries, and whether you talk to the auto guys or the power guys or even CMI, all of them indicate that there's a slowdown underway and it may take at least 6 to 12 months before investments actually pick up. How does that tie in with your 20% earnings estimates?
What we have not seen in the last 2 years is corporate margins. It's not lack of revenue growth. The revenue growth made a bottom a few quarters ago and is now well into double digits and has been rising sequentially quarter on quarter.
2 months back, this is a market which was clearly oversold, at least on the broader market side. Now, with all this dollar carry trades and ahead of elections and all that you're saying, is there a risk of this market seeing a bit of a melt up, Nifty making a sharp move towards say 11,500 to 12,000?
A lot of things went wrong for India between, say, September and February. And actually, it should surprise most people that the Nifty was very resilient through this phase. It hardly reacted to what I would say was a pretty challenging macro environment, whether it was the non-banking sector problem, the IL&FS problem, the RBI government problem, the fact that we had liquidity problem in the system overall. A lot of things went wrong. Oil prices shot up and then of course went down, but a lot of things went wrong and the Nifty should have behaved more poorly than it did. It hasn't actually behaved that poorly. In fact, if you look at it from the beginning of October to now, the Nifty is actually also flat against emerging markets. Remember, foreign portfolio flows have been very weak in India, and as a consequence, foreign holding in India is down to 7 or 8 year lows.
How important is crude as a risk factor for this market? Because while right now we are enjoying a liquidity factor, that's also pushing up crude prices. We saw last time our market underperformed because of this being a very big factor.
I think actually that a lot of India's underperformance in the first 6 weeks of this year against emerging markets was because oil rose relative to copper. Longer term, I think oil will reduce in importance because its share in India's GDP will keep declining over the next 3 to 5 years. But it's certainly a short-term factor.
Will not talk stocks, but what caught my attention were 2 or 3 real estate stocks. There was an overrepresentation of real estate in the list of stocks that came in the Morgan Stanley report, and this is coinciding with CLSA also putting up a slightly bullish report on real estate. You think those assets have troughed out and we should look for good stocks in that sector? My
view in January, when the elections were looking a little bit fuzzy, the election outcomes, our view was that beyond May, the market will start trading the growth cycle. So May will come and go, and the ballot will fade in importance very quickly. So yeah, I would hold on to that opinion as well. On sectors, I think if I were to characterize this in one line, I think you want to buy domestic cyclicals, both consumer cyclicals and industrial cyclicals. I think both of them look quite interesting. I think income growth is looking strong, and therefore consumption in the discretionary space should improve, which includes the likes of autos, airlines, it includes hotels, it includes a slew of sectors which are discretionary in nature. And then industrial cyclicals, which includes the host of industrials, engineering companies, construction companies, the big turnkey guys, everyone. So I think these are the 2 places that I would put money to. And then of course financials, where we would buy select non-banking financials. They have rallied, a lot of them have come back 20-25% from their lows in the last month, but they are still well off the tops. And I think a lot of the problems there have settled down. Growth in those companies may look a little bit tepid over the next year or so as they build more liquidity and capital on their balance sheets, but I think it's more or less in the price. And then, of course, corporate banks. We're going to get very strong earnings from corporate banks. So they are, you've got to have a bid on them all the way through. They will likely get re-rated and will report strong earnings over the next 2-3 years. So that's the space we want to be. On your question on real estate, I am very bullish on real estate, both commercial and resi. Commercial, the cycle probably troughed 2 years ago and is already on its way up. Resi, I think, will likely trough in the next 1 year or so.